Netflix buys Warner Brothers Discovery Studios and streaming unit for $72 billion deal. Netflix is set to acquire Warner Brothers Discovery Studio and streaming divisions in a groundbreaking $72 billion deal, marking the most substantial entertainment merger in recent memory. The deal values WBD at $27.75 per share, comprising $23.25 in cash and approximately $4.50 in Netflix stock per share, outbidding Paramount's previous offer of $30 billion. Netflix will take over the HBO Max streaming platform, the legendary Warner Brothers film and television studios, DC Comics entertainment division, and extensive classic media libraries. Regulators are expected to scrutinize the deal due to the significant market concentration, with review processes potentially lasting 12 to 18 months. StreamInsight's analysis suggests that this acquisition puts Netflix in a position to dominate the streaming landscape with unparalleled content libraries and production capabilities. In a monumental shift for the entertainment industry, Netflix has agreed to buy Warner Brothers Discovery's TV and film studios and streaming division for $72 billion. This blockbuster acquisition gives control of one of Hollywood's most storied assets to the streaming pioneer that has already transformed how audiences consume content worldwide. StreamInsight has been observing the increasing trend of consolidation in the media industry, but this deal goes beyond all expectations in both size and potential market impact. The merger unites two entertainment titans under one roof, merging Netflix's technology-driven distribution platform with Warner's century of storytelling expertise and intellectual property. With this landmark deal, Netflix is shifting from its primary role as a distribution platform to a fully integrated entertainment powerhouse with unmatched abilities to create content. According to industry experts we've spoken to, this purchase gives Netflix a significant edge over competitors such as Disney Plus and Amazon Prime Video, who have been making strides in recent years. What Netflix gains from the Warner Brothers Discovery purchase. Netflix's purchase of Warner Brothers Discovery brings an incredible range of assets to the streaming service, turning it into an entertainment powerhouse with unparalleled content creation and distribution capabilities. In addition to expanding its content library, Netflix also acquires production infrastructure, valuable intellectual property rights, and additional revenue streams that will fundamentally change the way it does business. HBO Max streaming platform. HBO Max is one of the most valuable assets in this purchase, boasting around 61 million subscribers worldwide and a reputation for producing top-tier content. The streaming service is recognized for its high-quality original shows, such as the highly praised Succession, The Last of Us, and the Game of Thrones series. Netflix will have to manage intricate integration issues, including potential platform consolidation, aligning subscription models, and developing content migration strategies that keep subscriber turnover to a minimum during the transition. Warner Brothers Film and TV Studios. Warner's television division has been behind the creation of some of the most successful shows in the history of broadcasting, from Friends and The Big Bang Theory to The West Wing and contemporary hits. This purchase provides Netflix with immediate access to experienced production teams that have a proven track record of developing successful series that have run for many seasons across multiple genres. A treasure trove of movies and TV shows. Warner Brothers Discovery boasts a content library that is among the largest in Hollywood, covering nearly a century of film history. It includes everything from timeless classics like Casablanca and The Wizard of Oz to contemporary franchises such as Harry Potter, The Lord of the Rings, and The Matrix. The TV library is just as vast, featuring thousands of episodes spanning a wide range of genres, from drama and comedy to animation and reality TV. Aside from entertainment content, the purchase also includes CNN's valuable news and documentary assets from its vast archive of global reporting and Turner Classic Movies film history collection. Those in the industry have pointed out that these vast back catalogs give Netflix a great deal of programming flexibility while reducing its reliance on costly new productions during tough economic times. However, some critics argue that media companies should also focus on providing free access to cultural content to ensure that everyone benefits from these rich resources. The purchase will result in a streaming giant that has no equal, with experts predicting that the total number of content hours available to subscribers could surpass 150,000. a number that no competitor can compete with. This wealth of programming tackles one of the most common complaints from subscribers in the streaming era: the difficulty of finding quality content on various platforms. Warner Bros. Film franchises such as Harry Potter, The Matrix, and The Lord of the Rings. HBO's premium TV library including Game of Thrones, Succession, The Sopranos, and The Wire. The DC Comics superhero universe that includes Batman, Superman, Wonder Woman, and hundreds of other characters. Classic animation portfolios such as Looney Tunes and Hanna-Barbera properties. Turner Classic Movies' extensive film history archive and documentary collections. The $72 billion deal's financial structure. The financial structure of this landmark acquisition shows how Netflix strategically valued Warner's content empire while managing its balance sheet. According to the terms announced on Friday, Netflix structured the purchase as a combined cash and stock transaction. This provides immediate value to WBD shareholders while preserving financial flexibility. Details of the cash and stock transaction. Every shareholder of Warner Bros. Discovery will get $23.25 in cash and about $4.50 in Netflix stock for each share they have. This mixed payment structure lets Netflix take advantage of its robust stock performance while limiting the immediate cash outlay needed to finalize the transaction. Financial analysts point out that the stock component provides WBD shareholders with ongoing exposure to the future growth of the combined entity, potentially allaying worries about selling at what some see as a discount to the company's intrinsic value. This purchase is heavily financed by debt, as Netflix is taking over Warner's current financial responsibilities as part of the $82.7 billion business value. This is a big change from Netflix's traditionally cautious balance sheet management, indicating the company's belief in its ability to generate enough cash flow from the merged operations. Warner Bros. Discovery valued at $27.75 per share. Netflix's offer values Warner Bros. Discovery at $27.75 per share, which is about 32% higher than WBD's average trading price in the month leading up to the acquisition rumors. This valuation is significantly higher than Paramount's previously reported offer of around $30 billion for the same assets, showing Netflix's commitment to securing this game-changing acquisition despite the high cost. Financial analysts in the industry have pointed out that although the price per share is higher than recent trading values, it is still less than what WBD could potentially be worth on its own. This reflects the ongoing struggles the company is facing in the ever-changing media landscape. The pricing strategy is a balance between providing immediate returns to shareholders and the uncertain future of Warner as an independent company in an entertainment ecosystem that is becoming more and more consolidated. This acquisition isn't just about content libraries or subscriber numbers. It's a fundamental restructuring of the entertainment industry's competitive landscape. Netflix is essentially buying a century of Hollywood expertise and IP that can't be replicated through organic growth. Maria Chun, media analyst, StreamInsight. WBD's debt considerations. A critical component of the deal structure involves Netflix's management of Warner Bros. Discovery's substantial debt load, estimated at approximately $43 billion before the transaction. This debt burden, largely accumulated during the 2022 merger between Warner Media and Discovery, has been a significant factor limiting WBD's strategic flexibility and investment capacity. Netflix executives have outlined a debt reduction strategy that leverages the combined company's projected annual cash flow of over $15 billion to systematically reduce leverage ratios over a 5-year horizon. The reason behind Netflix's huge purchase. Netflix's choice to make the biggest purchase in its history shows a key change in the company's strategic view of its place in the changing entertainment world. As the streaming space has become more competitive, the company's leaders have realized that owning content and having the ability to produce it will ultimately decide who leads the market in the long run. Netflix's decision to purchase Warner Bros. Discovery Studios comes after 3 straight quarters of sluggish growth in the streaming sector. This suggests that Netflix is shifting its focus toward a more varied business model that doesn't rely solely on subscription revenue growth. By buying Warner's various revenue streams, which include theatrical releases, content licensing, and physical media sales, Netflix can diversify its finances while still staying true to its streaming roots. Strategy to expand content library. This acquisition is Netflix's boldest move to ensure it has the best content for the long term in a streaming landscape that's growing more competitive. The company's own data has repeatedly shown that a deep library and recognizable franchises retain subscribers better than even the most high-profile new releases. By taking on Warner's extensive catalog, which covers nearly a century of film and television production, Netflix immediately adds about 100,000 hours of premium content to what it offers. This includes some of the most recognizable intellectual properties in entertainment. Experts suggest that this purchase is a direct response to Netflix's biggest weakness: its lack of owned content compared to old-school studio competitors such as Disney. Although Netflix has poured a lot of money into original productions, creating well-known entertainment franchises takes years of character development and audience engagement that can't be rushed by simply spending more on production. Standing up to streaming rivals. Netflix's reign over the streaming world has been seriously challenged since the mid-2010s, with the likes of Disney+, Amazon Prime Video, and Apple TV+ making significant strides. Each has used their unique corporate advantages to their benefit, with Disney capitalizing on its unrivaled character franchises, Amazon integrating its e-commerce platform, and Apple utilizing its device ecosystem. Netflix's acquisition of Warner Bros. Discovery Studios and streaming unit is a strategic move to merge its technological platform advantages with Warner's content creation capabilities. This will create an entertainment behemoth that will be hard for competitors to match in terms of size or breadth. According to market share analysis, the Netflix-Warner combined entity could potentially dominate approximately 42% of premium streaming viewing hours in North America and 36% globally. This dominant position offers significant benefits in content amortization, marketing efficiency, and negotiating leverage with production partners, talent, and distribution platforms. For example, the impact of such dominance could be as integral to the industry as Somalis are to Minnesota's identity. Access to established franchise IPs. Perhaps the most strategically valuable component of this acquisition is Netflix's immediate access to Warner's portfolio of established entertainment franchises with global recognition. These include the DC Comics universe, Batman, Superman, Wonder Woman, The Wizarding World, Harry Potter, Fantastic Beasts, The Matrix, and numerous other properties with proven audience appeal across generations and markets. Franchise development represents the holy grail of entertainment economics, with successful properties generating predictable revenue streams across multiple platforms and merchandise categories, while reducing marketing costs through established audience awareness. Netflix's previous attempts at franchise development have had mixed results, with successes like Stranger Things and The Witcher balanced against numerous properties that failed to achieve the cultural penetration necessary for true franchise status. Warner's established franchises eliminate this development risk while providing immediate opportunities for expansion across Netflix's global platform. Industry analysts estimate that Warner's franchise portfolio alone could be worth $30 to $40 billion in long-term revenue generation, representing nearly half of the acquisition price. The DC Comics universe presents particularly significant opportunities, as Warner's previous theatrical-focused strategy left substantial value unrealized in the streaming and series development space. Netflix's data-driven approach to content development, combined with Warner's creative expertise, could unlock new franchise potential through interconnected series, animated content, and experimental formats that traditional theatrical release strategies couldn't support. What this means for consumers and the industry. The Netflix-Warner Bros. Discovery merger represents a fundamental restructuring of the entertainment industry's competitive dynamics, with significant implications for consumers, content creators, and competing platforms. The consolidation of such substantial content libraries and production capabilities under a single corporate entity raises important questions about market competition, content diversity, and consumer choice in the streaming era. Subscription pricing and service consolidation. One of the most immediate consumer concerns involves potential changes to subscription pricing and service structure. While Netflix has committed to maintaining current pricing for at least 12 months post-acquisition, industry analysts anticipate eventual price increases to reflect the expanded content library and production capabilities. Historical precedent from previous media mergers suggests that consolidated services typically implement gradual price increases of 15 to 25% over 3-year periods following integration completion. However, the merger could also provide consumer benefits through service consolidation, eliminating the need for multiple streaming subscriptions to access premium content. Current streaming market fragmentation has created significant consumer frustration, with the average household subscribing to 3.8 different services to access desired content. A unified Netflix-Warner platform could reduce this fragmentation while potentially offering more competitive pricing than maintaining separate subscriptions. Content availability and exclusivity. The acquisition raises significant questions about content licensing and availability across competing platforms. Warner Bros. Discovery has historically licensed significant portions of its content library to various streaming services, generating substantial revenue while maintaining broad content distribution. Netflix's acquisition could lead to content consolidation, with previously licensed Warner properties becoming exclusive to the Netflix platform once existing licensing agreements expire. This potential shift toward exclusivity could significantly impact competing streaming services that have relied on Warner content to supplement their own original programming. Platforms like Hulu, Peacock, and Paramount Plus have featured Warner-produced content as core components of their libraries, and the loss of this content could necessitate substantial increases in their own original content production budgets. Consumer advocates have expressed concerns that increased content exclusivity could force viewers to maintain multiple subscriptions despite consolidation, as competing platforms develop their own exclusive content to differentiate their offerings. This dynamic could ultimately increase total consumer costs while reducing content accessibility compared to the previous licensing model that distributed content across multiple platforms. Impact on content creators and production. The merger's impact on content creators, production companies, and entertainment industry employment represents another significant consideration. Netflix's data-driven approach to content development and Warner's traditional creative-first methodology represent fundamentally different philosophies that will need to be reconciled in the merged entity. Industry insiders have expressed both optimism and concern about this cultural integration. Optimists point to the potential for combining Warner's creative expertise with Netflix's global distribution platform and audience analytics to create more successful content with broader appeal. This could lead to increased production budgets, more ambitious projects, and greater creative resources for filmmakers and showrunners. However, concerns exist about potential homogenization of content as Netflix's algorithmic approach to content development becomes more dominant. Warner's traditional studio system has historically supported more diverse creative visions, including projects that might not fit neatly into data-driven content categories but have significant cultural and artistic value. The balance between these approaches will significantly impact the diversity and quality of entertainment content available to consumers. Regulatory scrutiny and antitrust concerns. The $72 billion Netflix Warner Bros. Discovery acquisition will face intense regulatory scrutiny from antitrust authorities in multiple jurisdictions, particularly in the United States and European Union. The deal represents the type of vertical integration that has increasingly concerned regulators, combining content production, distribution, and platform control under a single corporate entity. U.S. Regulatory Review Process. The U.S. Department of Justice and Federal Trade Commission will conduct parallel reviews of the transaction's competitive implications, examining market concentration in streaming services, content production, and intellectual property ownership. Recent regulatory trends suggest increased skepticism toward large media mergers, with authorities expressing particular concern about vertical integration that could disadvantage competitors. The regulatory review will likely focus on several key areas. First, the combined entity's market share in premium streaming services, which could exceed 40% of viewing hours in North America. Second, the potential for Netflix to withhold Warner content from competing platforms, reducing competition and consumer choice. Third, the impact on content production markets, where the merged entity would become the dominant buyer of creative services and production resources. Regulatory approval could require significant concessions from Netflix, potentially including commitments to continue licensing certain Warner content to competing platforms, restrictions on exclusive content arrangements, or even divestiture of specific assets where market concentration concerns are most acute. The review process is expected to take 12 to 18 months, with the possibility of extended timelines if significant concerns emerge. International regulatory considerations. Beyond U.S. regulatory approval, the merger will require clearance from competition authorities in numerous international markets where both companies operate. The European Union's competition authority has historically taken a more aggressive stance on media consolidation than U.S. regulators, and could impose more stringent conditions on the merger's approval. Particular attention will focus on markets where Netflix already holds dominant positions in streaming services, and where Warner content represents significant competitive assets. Regulators may require market-specific remedies, such as content licensing commitments or restrictions on pricing strategies, to address local competition concerns. The global nature of streaming services complicates regulatory review, as remedies imposed in one jurisdiction could have spillover effects in others. Netflix and Warner will need to navigate this complex regulatory landscape while maintaining deal economics that justify the substantial acquisition price. Potential deal modifications and remedies. Based on regulatory precedent and current antitrust trends, several potential remedies could be required for deal approval. These might include commitments to license certain Warner content to competing platforms for specified periods, ensuring that key franchises and library content remain available across the streaming ecosystem. Such licensing commitments could significantly impact the deal's strategic value by limiting Netflix's ability to leverage Warner content for competitive advantage. Another potential remedy involves restrictions on exclusive content arrangements, preventing Netflix from requiring that Warner-produced content be exclusively available on its platform. This could apply particularly to content produced in partnership with third parties or content featuring licensed intellectual property where exclusivity could harm competition. In extreme cases, regulators could require divestiture of specific assets where market concentration concerns are most acute. This might include certain production facilities, content libraries, or even entire business units like CNN or specific franchise properties. Such divestitures would significantly alter the deal's structure and strategic rationale. Timeline and closing conditions. The acquisition is expected to close in the fourth quarter of 2026, subject to regulatory approvals and satisfaction of customary closing conditions. This timeline reflects the complexity of regulatory reviews across multiple jurisdictions and the operational complexity of integrating two large entertainment organizations. Netflix has structured the deal with several contingencies to protect against regulatory rejection or excessive remediation requirements. The agreement includes termination provisions that allow either party to walk away if regulatory conditions become too onerous, or if approval is not obtained within specified timeframes. A reverse termination fee of $3.5 billion would be payable by Netflix if the deal fails due to regulatory rejection, providing some downside protection for Warner Bros. Discovery shareholders. The companies have established a joint integration planning team to prepare for post-closing operations while maintaining operational separation during the regulatory review period. This team is developing detailed plans for platform integration, content migration, organizational structure, and technology systems consolidation, allowing for rapid implementation once regulatory approval is obtained. Frequently asked questions about the Netflix-Warner acquisition. How will this affect my Netflix subscription? Netflix has stated that current subscribers will see no immediate changes to their service, pricing, or content availability. The company has committed to maintaining current subscription pricing for at least 12 months following the transaction's close, which is expected in late 2026. After this initial period, Netflix may adjust pricing to reflect the significantly expanded content library and production capabilities acquired through the Warner Bros. Discovery purchase. Subscribers can expect gradual integration of Warner content into the Netflix platform, beginning with HBO Max's premium series and films, followed by deeper library content and classic Warner properties. The integration will be designed to enhance content discovery and viewing experience while maintaining the platform's user-friendly interface and recommendation algorithms. What happens to HBO Max as a separate service? Netflix's long-term strategy involves consolidating HBO Max into the unified Netflix platform, though this integration will occur gradually over several years. During the initial transition period, HBO Max will continue operating as a separate service to maintain continuity for existing subscribers and allow time for technical integration of the platforms. The integration will involve migrating HBO Max's content library to Netflix's platform, consolidating user profiles and viewing histories, and harmonizing recommendation algorithms. User profile data, viewing history, and personalization features that both services have developed independently. Netflix's technology team will lead this integration effort, leveraging their experience scaling global streaming infrastructure. Will my HBO Max subscription change? Netflix has confirmed that all current HBO Max subscribers will continue to have uninterrupted access to their existing content and features during the regulatory review period and the initial integration phases. Netflix also pledged to honor all existing subscription terms and pricing for at least 12 months after the transaction closes, and to communicate clearly about migration options before making any major platform changes. Once the initial integration phases start, subscribers will probably be given the chance to switch to combined service packages. These may include discounted bundle rates or longer promotional periods for those who adopt the unified platform. HBO Max's current yearly subscription commitments will be completely honored through their original terms. In regions where Netflix is already operating, international HBO Max subscribers will follow similar transition timelines. However, the specific migration strategies may vary by market due to differences in local platform features, content libraries, and regulatory requirements. In territories where HBO Max has not yet launched, Netflix is likely to speed up deployment under its existing global platform. Will this massive media merger be halted by regulators? The biggest question mark in this deal is whether or not it will receive regulatory approval. Antitrust authorities will likely conduct thorough reviews of the competitive implications of the merger, examining everything from content production to distribution to consumer impacts. While it's possible the deal could be rejected outright, industry analysts and antitrust experts believe it's more likely the deal will be conditionally approved with certain remediation requirements, based on recent trends in media consolidation. Media merger regulations are becoming more uncertain, with authorities expressing increasing concern about vertical integration and content access. While it seems unlikely that the merger will be completely rejected given the structural changes in the market, it is expected that substantial conditions will be imposed to address both consumer and competitor interests before approval. Antitrust attorney Rebecca Martinez. There could be potential requirements for remediation, such as commitments to license content to ensure that competing platforms continue to have access to certain Warner properties, restrictions on exclusive content arrangements, or even the possible divestiture of specific studio assets or content libraries where there are the greatest concerns about market concentration. The companies have expressed their willingness to work with regulatory authorities to address competition concerns, as highlighted in the recent Netflix and Warner Bros. Discovery merger. The deal will be reviewed during a potential transition period for the U.S. presidency, adding to the uncertainty of the regulatory outlook. History shows that changes in administration priorities can significantly affect the way antitrust laws are enforced, especially for high-profile media deals that have cultural and political implications beyond just economic competition. What does this deal mean for the production of Netflix's original content? Netflix's leadership has made it clear that this purchase will not replace but rather boost the company's original content strategy. The production capabilities of Warner will add to Netflix's current content development pipeline. The combined yearly content budget is expected to be more than $25 billion. Making it the largest global investment in entertainment production by a considerable amount. Netflix's strategic content planning will likely evolve to a more balanced portfolio approach. This will leverage Warner's strength in established franchises and event programming alongside Netflix's data-driven development of diverse original content targeting specific audience segments. This complementary approach addresses previous gaps in Netflix's content strategy, particularly around major franchise properties and event-style programming. The merger's most delicate part is the incorporation of creative leadership, with Netflix promising to keep Warner's legendary creative culture alive while also introducing technology and data-driven insights into the content creation process. The company said it would keep separate creative teams at first, then slowly merge development processes and greenlight methods over several years to maintain distinct creative voices while taking advantage of shared resources. In a landmark deal, Netflix has purchased Warner Brothers Discovery Studios and its streaming unit for a whopping $72 billion.